Hello ladies and gentlemen, welcome to Common Basic Things. As you may not know, my name is Cruz, and today what I'll be talking about are buying calls and call debit spreads and the risk in spreads when you have options in the money. Now before I do start, keep in mind that I am not a financial advisor nor a licensed professional. If you'd like to invest in the stock market, please consult with one first. These videos are strictly for entertainment purposes only. Please do not try what I'm about to show you guys, and if you'd like to invest in the stock market, invest at your own risk. Secondly, please smash that like button and subscribe. Sometimes it takes me hours to make these videos, so any like or comment is greatly appreciated. But no, in all seriously, it does take me some time, so thank you guys again. Now, before I do get started, just a quick reminder in case you don't see the trading options on the bottom right of any stock, if you were to choose one, like right over here, you are going to have to enable it. Once you have it enabled, you'll be able to sell and buy puts, but you still won't be able to do spreads until you have a level 3 account. So just keep that in mind, guys. But once you have that ready, let me show you an example. Let me go back to my favorite stock. Right, this is honestly one of my favorite stocks to do options trading in, just because it's not very volatile, but it did, just like I said, have a correction. But now what you're gonna want to do once you have the trading options enabled, you're gonna go into trades. And you, like I said, you can buy calls, you can buy puts, you can sell calls, you can sell puts. But what we're going to be talking about today is buying calls. Buying a call, this is what you're going to be paying. This is you're going to have to be paying this. So it's going to be like 525, but you're going to be able to control 100 shares. You're buying it at a 78 strike price, and you have the option to exercise that. But as you can see here, your break-even price, it even shows you, it shows it to you, is 83.25. So if you were to get this and it expires on the 11th, then you're going to want the price to at least be higher than 83.25 in order for you to even break even. And after that, then anything else, it'll be profit. What you're going to do is really look for a stock that you have a bullish opinion on. One that's not that volatile, because you're buying calls, you're going to want that stock to be going up. Depending if you're going to do a credit spread or a debit spread, different things do go into consideration. But just buying a call in general, you are just hoping that the price of the stock goes up. But let's say you wanted to do a call debit spread, right? So when you're doing a call debit spread, what you're really hoping for is the price of the stock to go up. A good way to really see how much you'd be profiting, there's this calculator online. It's called Options Profit Calculator. This really help you visualize your profits and your risk depending on the spread that you'd be doing. It's really a great tool disposal just to be able to see and visualize how it's gonna be long term, depending on how long you're gonna set the expiration date to. But like I said, we're gonna do calls, right? So let's go to calls here. So let's use AMD as an example, right? So now let's go to the 18th, all right? And let's say we'd be buying this one right over here. We'd be buying, let's buy the one that's 76, right? All right. Be buying the one that's 76, and we'd be selling the one that's 77. We don't want to risk too much, all right? Or net debit, which is what we'd be losing technically if by any chance that you see that's our maximum risk if it expires at 76. It gives you some wiggle room, and it's not gonna require you to have a lot of collateral down. As you can see, it's only 75, and you'd be getting a 25 credit as long as it's an expiration date at 81. If not even less, it doesn't even have to be at 81. It can be all the way down to 77, which is the one you'd be selling at. As you can see, your maximum risk would only be 75, and your return would only be 25. So that's really the main benefit when you're doing a credit spread. A lot less collateral that you'd be having to put down, but it does minimize the reward as well. When you're buying a call, you're hoping the price of the stock goes up. When you're buying a put, you're hoping the price of the stock goes down. IWM, I think. So an example I could use for this is, let's say IWM, right? It's at 152. So that is a little bit pricey, but let's say we're gonna choose a call. Let's do the 25th again. All right, right now it's at 152. So let's say, for example, we want to 145. All right. Say we don't think it's gonna go below that, but we're gonna have to be paying this premium of 964. So when you calculate this, as you can see, time decay, which is another thing you have to be looking at. So we chose the 145 strike price. So if you go all the way down here, right, and we choose the strike price, their premium is $941, right? Believe that's the same one as this one, 964. This is a little bit off, but as you can see here, the upside to it is it's much greater. You're only risking 964, but your maximum return is really pretty much like, you know, all up, all green up from there, as long as it doesn't drop below that or stays at that same price. um, so like I said, usually people play earnings when they're doing this because you're bullish on the stock. You're hoping it's gonna, you know, go up and skyrocket. That's how you'd be making the maximum profit. Like as you can see here, you see you can even make more. You know, you could even make more than that. Uh, this is just this is just calculating. Like let's say it just drops, like skyrockets 180. I mean, you could be making a lot more. Like I said, it is, you'd be risking that amount, but the potential reward is much higher. And that's really the difference, because if you're selling a put, let's say for example you'd be selling this put, as you could see here, you'd be putting 15K pretty much as collateral. But like I said, if you were to be doing you'd be selling puts, well, I mean, honestly, the maximum risk is just the strike price dropping, you know, I mean, the share price dropping below your strike price, because you'd be forced to buy it at a higher price than what market has it at. But then again, like I said, you'd be keeping this premium, and you could continue the wheel. You could, from selling puts to selling calls. And let's say it did drop all the way down to 151 and it's at 150, right? Well, I mean, you could go back into selling calls, and as you see, these are the premiums that they'd be paying you. So let's say you were to choose like 155, and you already had to own 100 shares of this stock. Well, I mean, you could go right here and sell this call. If you'd be selling this call, you'd be getting $334 pretty much for you know, like I said, it's just a wheel. You have to just continue the cycle. Usually when you're trading options, you're just gonna want to have like a steady source of income, and when you're selling puts and selling calls, it's just a wheel cycle. It's not, you're having a lot less risk. That's why I would suggest doing it on a stock that, you know, doesn't have too high volatility. This one, a great example, IWM. As you can see, the resistance level is pretty much at around like 147, 149, like 145. This one was pretty great. It's 128. So the resistance level did go up and down, but pretty much at like 140, 145, I would say it's a good resistance level. Like 140. So if you were to be selling these calls and puts, it's really just a easy way of making extra source of income weekly. And like I said, if you did have this amount of money, or if you just wanted to do spreads, you know, because it doesn't take that much collateral. But yeah, my account did hit a kind of low right now. Like I said, it's going up. It's just steady. Like I said, I'm gonna just go back into doing my bread and butter, selling calls and puts. It's gonna be the easiest way to make a steady income and grow your account without having such high risk. That's pretty much all I had for you guys today. I hope you guys enjoyed this video. If you have any questions, anything, just please like, comment down below. Thank you guys for watching. I appreciate you. You have a good day.